Broadcom had a remarkable run in the last year and could deliver returns of almost 100% in 1 year alone. With a dividend growth of more than 17% on a 5-year basis, they are also a prime candidate for many dividend growth investors. But is this growth also sustainable? And how does their recent push in the AI space that they just reported on in their quarterly update from last week and the acquisition of VMware fit into their business? Well, in today's video I'll break it down. I'll look at the business models and the markets of Broadcom, analyze their strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check their valuation and do a discounted cash flow calculation to see if now is a good time to buy. So sit back, relax, and let's explore Broadcom's investment potential together. My name is Florian, welcome to Cashflow Maniac. Broadcom has the ticker symbol of AVGO and they are working in the semiconductor sector. They were founded in 1961 and have around 20,000 employees at the moment. The headquarters sits in Palo Alto, California, and the market cap at $840 billion at the moment. Broadcom is a global technology leader that designs and supplies a broad range of semiconductor and infrastructure software solutions. Their broad portfolio includes advanced digital and analog semiconductor products as well as software solutions. Compared to some of their competitors, however, they don't produce the chips and products by themselves, only design them and let them produce by foundries like TSMC. The company is known for their aggressive acquisition strategy, which has allowed them to diversify its product offerings and enter new markets rapidly. The innovation-driven culture and the focus of the CEO Hock Tan on efficient and lean operations has enabled Broadcom to deliver high-performance products and solutions as well as a strong financial performance. The stated goal of Hock Tan is to build the world's leadest infrastructure technology company. And he does this with the many strategic acquisitions the company made over the last decades. Many of their core products came from such activities like their networking chip-making business that they already acquired back in 2001 when they took over ServerWorks, or the enterprise security business that they purchased with Symantec in 2019. Their latest acquisition, VMware, was even one of the biggest deals in tech history with an eye-watering $61 billion net purchasing price. Around 60% of their revenue is generated in the semiconductor solutions sector, while the remaining 40% are generated in infrastructure software. Their portfolio includes products and components for high-performance networking, for example, like switching, routing, or even optical connections like glass fiber. They provide end-to-end solutions like Wi-Fi routers, many different products for the wireless and mobile device connectivity space, like components for a Wi-Fi and Bluetooth combination, touch controllers, inductive charging devices. For the industrial space, they also provide a lot of products for connectivity and also for sensing, like optical sensors, for example, motion controllers, optical isolators like optocouplers and so on, and also their Ethernet portfolio. In terms of software, they also provide a plethora of different products for cybersecurity, payment security, identity management, but also products for cloud computing and server farms. And with its broad range of software products for server, networking and storage virtualization, VMware software virtualizes different kinds of hardware. These products are critical for companies aiming to optimize their IT infrastructure and reduce costs. These applications include data centers and cloud computing, but also other businesses in the healthcare, government, or even retail and finance industry. Basically everywhere where a secure and robust IT infrastructure is critical. So many of the products can or even need to be used for AI infrastructure, and of course, AI is also a big part of the growth story they are trying to sell at the moment. So if you want to know more specifically about their AI potential, stay tuned. We'll discuss this in a bit when we come to the financial analysis. Broadcom is mostly active in the American market, including Canada and South America, and this makes up 47% of their revenue. The European, Middle East and Africa market is the second largest one with around 38% of revenue, and the Asia Pacific market is with around 50% the smallest one. A bit more than 3/4 of the revenue are coming from product and software sales, while around 22% is recurring revenue from subscriptions. The company is actually trying to further increase this subscription-based revenue, for example, by switching VMware's business from a license to a streamlined subscription-based model. Because of the different fields that Broadcom is working in, it is hard to estimate an overall trend of all of their markets and put an overall growth forecast on it. So instead, I looked at 3 of their most important segments. The first one is the data center networking market, which is the most important market for their semiconductor solutions segment. And this market is expected to grow with a CAGR of 11.1% until 2033. The second one is the market for cybersecurity solutions, which is expected to grow even quicker with 12.3% annual growth rate until 2030. The growth forecast for the US, which makes up almost 50% of their revenue, is quite a bit lower though, with only 7.4%. Last but not least, I also looked at the market for virtualization software that covers the latest acquisition VMware, and here the forecast is a global growth of 9.5%. So I think it is fair to say that Broadcom is operating in several growing markets with secular trends, so it definitely has some tailwinds here. I found a very insightful interview with Kawwas, the president of the semiconductor group, where he talks about the general markets and the strategic direction of Broadcom much better than I ever could. So let Charlie briefly explain the overall strategy and direction, because I think that this already tells us much about the company and what we can expect from an investment in Broadcom.
So for us, we spend time making sure that when we want to invest in a market, we invest for at least a decade. Many people don't know this about Broadcom actually. So when we say we are in a certain business, we commit to 10 years plus. That is extremely important for us. Now, most people say, I want to invest in a space that has a hockey stick. Many people do that. Yeah. That's not what we do. Sometimes it happens to be like AI and generative AI, which is great. Yeah. But you know what? That's not what we're looking for. Even if a market in 10 years is declining low single digits, that is actually exciting for us. For many people, it's boring, it's legacy. Big mistake. So first, the market, 10 years plus. 2, most importantly, technology leadership. That is the most important thing that we do at Broadcom. In the 26 categories, and specifically the 17 on the hardware side, we have to be the technology leader over that span of 10 years.
So they aim to be the long-term leaders in the markets they are active in. But how good is their position really? And what are the risks? Let's try to find this out by doing the Porter's 5 forces analysis. First of all, I would estimate the threat of new entrants as low. Even though Broadcom does not produce their own chips, there are still high entry barriers in this market because of the significant necessary investments in R&D. Their 90,000 patents also show the wealth of know-how that also provides an edge against new companies. The threat of substitutes I would also estimate as quite low. With their broad range of products, they claim that 99% of all internet traffic crosses some type of their technology. These components often have unique features or are designed for specific applications or industries, making it very hard to find direct replacements. Most of their components are, however, available from other producers, just not in the diversification and sometimes the performance that Broadcom can offer. The competitive rivalry I would estimate as quite high. There are numerous competitors in the semiconductor industry driven by rapid evolving technologies and very dynamic markets. So the company has to keep innovating, or in their case, acquiring innovative companies to stay relevant, and this competition also definitely drives the profit margins. The bargaining power of the customers I would also estimate as quite high. Broadcom has a high customer concentration, with Apple accounting for around 20% of their revenue in the last few years. This concentration, combined with the high volume purchases, gives these big customers quite some power. Usually there are also alternative products out there, and especially in case of standardized products, this makes it easier for customers to switch to other suppliers. The bargaining power of their suppliers I would also estimate as medium to high. The complex supply chain and the specialized components or technologies that are necessary to manufacture their products gives these suppliers quite some negotiation power. Sometimes Broadcom also relies on patented technology that they need to license and that is not easily available otherwise. So overall, with their diverse portfolio and a strong emphasis on R&D as well as strategic acquisitions, the company has currently a good position in the market. However, the rapid technological shifts in the semiconductor industry mean that Broadcom needs to stay vigilant. But I also think that the moat of the company is not too big, as many products are also available in the same or at least similar form from other suppliers. The company also still needs to prove that they really can benefit from AI as much as their marketing suggests. But we'll come to this in just a bit. If you do like the video so far, please smash the like button and consider subscribing to the channel in order not to miss my next video. Before we dive into the details and the nitty-gritty of their financials, let's start from the top and check Broadcom's performance over the last years. And on a one-year time frame, the company could easily outperform the S&P 500 with almost 100% total return. On a 5-year base, it looks similar and the company could deliver very impressive 600% returns. And believe it or not, over the last 10 years, this gets even better, and with an impressive performance of almost 3000%, they left the general market in the dust. The overall business growth over the last decade was also quite nice, and the company could grow their revenue by 14.3% annually on a 5-year basis, their net income even by 22% annually over the 5-year basis, their free cash flow by almost 14%, and their earnings per share even by 25% annually. So we can see a very nice and stable growth on the top as well as on the bottom line. What is also nice to see is that the margins of the company are generally increasing or at least staying stable in regards of the ROIC. Their EBITDA also shows a nice growth, and their long-term debt to EBITDA sits at 3.5 times right now. This is a little bit higher than what I usually would like to see with a long-term debt to EBITDA multiple of 3 times. But with the many acquisitions of Broadcom and especially this increase in debt with the acquisition of VMware, this is still quite impressive. But unfortunately, in addition to the increase in debt, the company is also issuing shares on a regular basis. The annual share dilution over the last 5 years was sitting at 2.44%, but actually the company is also buying back shares from time to time. Broadcom is also paying a dividend, and the dividend is very well covered at the moment from their free cash flow. Unfortunately, the stock price compensation, while never really low, jumped up to around 20% of their free cash flow after the VMware acquisition, which is indeed quite high. I am very curious to see how they want to handle this in the future before it gets out of hand even more. The goodwill also increased very significantly and makes up 55% of the total assets already, which is also quite high. But to be fair, the goodwill of Broadcom was on a similar level for the last 10 years. So this is nothing new. But compared to other AI stocks like Nvidia that actually earn money with their AI chips, the latest run-up of AVGO stock price by more than 20% is not supported by the fundamentals, but was mostly triggered by the Q2 report last week, where they also hyped up their AI business. In this report, the company announced a guidance for the full year 2024, where they expect a total revenue of $51 billion, including VMware, which is an increase of 42% from last year. But if you take a look at the individual reports from VMware and Broadcom from last year, we see that the combined revenue last year was 49.15%. So the real organic growth was in fact under 4%. Another very interesting part is the one where the company states that their revenue generated by AI products was a record $3.1 billion in the last quarter. And I did promise you some more details on this. So before looking at the future potential and the forecast of the company, let's take a deeper look into their AI expectations. So for the full year of 2024, Broadcom is expecting a revenue of $10 billion with AI. But this revenue is basically rebranded revenue from different segments in their broadband, networking and storage applications. And to put these 3.1 billion into context, we should also look at the overall semiconductor business. Here, the overall growth was just 6% on a year-over-year basis. So, even though the company is generating money on AI, the overall segment has only grown at half the expected market growth. And to be very clear, in the current semiconductor down cycle, this is nothing unexpected or overall bad. But I find the way the company is communicating this quite a bit misleading. So we should ask ourselves, how much of the AI potential they are hyping up at the moment is real and how much is only marketing? And to answer this, we first need to understand what kind of products Broadcom can actually provide for AI applications. The server clusters that AI is running on are composed of not only one processor or what Broadcom calls XPU, but several of them connected in one AI node. These nodes or servers are then further interconnected to huge server clusters. Of course, to connect these XPUs first and also the servers, PCI switches and NIC cards are necessary for fast connections. Last but not least, to connect these server clusters to the outside world and the internet, a front-end connection is needed, usually done with top-of-the-rack switches or Tor and spine switches. Once you have all that, you also need some high-speed connection, usually done via glass fiber. And Broadcom has products in all of these segments. Everything shown here in red or with a yellow glow can be provided by Broadcom. But if Broadcom has so many products for AI, why didn't their fundamentals benefit from it yet? Basically, there are two major technologies available for inter-server connections where most of their products are used in. There is the open standard Ethernet and NVIDIA's InfiniBand. And while Broadcom states that Ethernet is superior here, there are points to be made for both technologies. I don't want to go too deep into the technical details here, but I'll leave you the link to Broadcom's AI infrastructure investment meeting and also to some technical explanations about the difference between InfiniBand and Ethernet in the description below. To close this topic, I'd just like to point out that this is not a fight between NVIDIA and Broadcom, as Broadcom sometimes like to depict it. Because NVIDIA themselves are aware of the advantage of Ethernet and are actually not only providing products for InfiniBand, but also for Ethernet, like for example their Spectrum switches. Most analysts expect a very good performance in the next years with an annual EPS and revenue growth of 16.7% per year until 2027. They are also quite optimistic about the stock performance, with the average one-year price target being around 30% above the current stock price, the lowest estimation 6% below the current price, while the highest one gives an upside of 26%. We already saw that the acquisition of VMware had some effects on their stock-based compensation and their goodwill. But each acquisition also brings risks related to the business, and it is by far not sure yet if the price of $61 billion that Broadcom paid will be worth it in the end. And while VMware may be a perfect fit into Hock Tan's vision for Broadcom, many customers of VMware don't like the way that Broadcom is doing business. Especially the switch from a license-based model to subscription-based one increases the costs for many customers and makes them concerned about the impact of this cost increase on their business. The most affected by this are smaller or mid-sized companies, and many of them are actually considering switching. The numbers vary quite a bit here, but the expectations are that between 20% and around 35% of their customers are at least considering switching to alternative solutions. And of course, this would have a huge impact on the overall growth of Broadcom. This is also especially concerning when we look at the current valuation of Broadcom. The multiples EV to EBITDA, PE and price to cash flow are currently at the highest level that they have been in the last 5 years, and except for the PE ratio, they are also the highest in the last 10 years. The dividend yield, on the other hand, is close to the lowest it has ever been over the last 10 years and is even 60% below the 5-year average. So, from a dividend yield perspective, the company is also quite expensive. As we saw, the company is also paying a dividend with a yield close to 1.2%. They could also grow the dividend in the last 5 years with an annual growth rate of 17.5%, which is a very good dividend growth. When we look at the dividend history though, we see that the growth has slowed down quite a bit in the last few years. Coupled with the increase in long-term debt, it will probably be hard for the company to keep up this high historical growth rate of theirs. When comparing Broadcom to some of their peers, their total return of the last year is only second to Micron. In the last 5 years, AVGO had the best performance and was only surpassed by AMD in the last 10 years. So the company could definitely deliver impressive returns over the last decade. The valuation, while high, is not the highest of the bunch, but what I find interesting is that the forward PE ratio for the next fiscal year is declining much slower than their peers and is expected to be the highest of the bunch. So, is Broadcom a good long-term investment or not? First, there is plenty to like about the company, starting with their impressive performance over the last decades, their diversified portfolio of products in the semiconductor as well as the software sector, and their keen eye on good acquisitions. It is also impressive and not all that common to be as successful as the company in streamlining these new acquisitions and optimizing their performance. But with the sheer size that Broadcom reached after their acquisition of VMware, it will be much harder to find fitting businesses to acquire that make a dent in their revenue. And because the company did manage much of their growth with these past acquisitions, I think it will get harder and harder for them to keep growing at the same pace. These acquisitions are always risky, and we see this with the current discussion about the change in business model for VMware, which brings a good risks to lose some customers, at least in the short run. And even though I think that the company has some good potential in the AI space with their existing products, at the moment the impact of this is not as big as the company would make us to believe. And due to their focus on acquisition, this growth is also risky and will probably slow down compared to the last years. I was actually debating investing in Broadcom around 1.5 years ago, but in the end I decided to invest in Texas Instruments instead. The two main reasons for this were, first, that I just like companies more that are growing organically, and second, that TI is producing their own chips while still being able to achieve almost the same profit margins as Broadcom, even though a producing business usually has much higher costs compared to a design house. I also don't like the high customer concentration of the company, which I find again quite risky. But I also have to say that since deciding for Texas Instruments, at the moment at least, an investment in Broadcom would actually have yielded significantly better returns. So please, before investing, do your own research and only use this video as a starting point for your own analysis. If you're interested in a full analysis for Texas Instruments to see my investment thesis for them, check out this video where I'll go over all the details for the company. And if you don't want to miss out on my next video, please feel free to subscribe and smash the like button to help the YouTube algorithm. As a small channel, this really helps me out tremendously. That being said, thank you so much for watching guys, and see you in the next video.